Imagine, retirees, a hidden liability, roughly the size of a small country, suddenly popping up in your pension portfolio. I'm Gregory Hale, and after spending a decade covering Wall Street's biggest deals and working as a senior analyst for a pension risk consultancy, I've seen how quickly a quiet warning can turn into a market-shaking reality. It's pretty wild, if you ask me. In this video, we're gonna dive into why Blackstone's latest alarm isn't just another analyst's note, how these reperforming loans have been tucked away into opaque secondary market paper, and why that hidden $4 trillion exposure could force millions of retirees into a liquidity crunch. It's a pretty scary thought. Disclaimer: the following analysis is based on my own research and interpretation. Take it for what it's worth. It's not legal or financial advice, and the entities mentioned aren't endorsing this content, just so we're clear. The warning came straight from Blackstone's own filing, where the firm disclosed that its private equity platform now manages roughly $4.5 trillion in assets. That's a huge number. Source: SEC filing. But what really caught my attention was the part about a secondary market paper, composed of leveraged loans that had slipped back into covenant compliance after a period of default, what academics call reperforming loans. Source: academic paper. These loans aren't just sitting on some tidy spreadsheet, by the way. They're bundled into securities sold to institutional investors, many of whom are pension funds looking for higher yields. It's a bit of a gamble, if you think about it. The Preqin 2023 Global Private Equity Report confirms that leveraged loan portfolios dominate the private equity asset class, making up a big chunk of that $4.5 trillion total. Source: industry report. What makes the situation really volatile is the market's lack of transparency. It's like trying to navigate a dark room. Unlike publicly traded bonds, these secondary market papers don't have a clear pricing mechanism. When Blackstone warned that a collapse in this niche could unleash a $4 trillion shock to institutional investors, it wasn't just talking hypotheticals. It was describing a structural fragility that could ripple through pension fund balance sheets. Source: Financial Times article. Pension funds worldwide collectively hold an estimated $500 billion in private equity-backed debt, much of it tied up in the same illiquid securities. That's a lot of money. Source: Reuters. Because these assets can't be readily sold without triggering steep discounts, a sudden market freeze would force funds to mark down their holdings, eroding the capital buffers that protect retirees' payouts. It's a bit of a perfect storm. Imagine a retiree who's counted on a steady pension stream for the next 2 decades. It's a pretty comforting thought, right? But if their fund's private equity debt portfolio is forced down by even a few percentage points, the shortfall has to be covered elsewhere, either by cutting benefits, raising contributions, or dipping into reserve funds that were never meant for such shocks. The core of the risk lies in the reperforming nature of the loans. It's a bit of a misnomer, if you ask me. These are loans that had breached covenants, entered default, and later returned to compliance, often after costly restructurings. While a return to compliance sounds reassuring, the underlying credit quality remains compromised, and the secondary market pricing doesn't fully reflect that lingering risk. It's a bit of a ticking time bomb. Because the loans are packaged with other assets, investors can't just cherry-pick the safe pieces. It's all or nothing, basically. The whole bundle moves as one, meaning a deterioration in any constituent loan can drag down the entire tranche. It's a bit of a domino effect. That interdependence is the engine behind the ticking time bomb metaphor Blackstone used in its alert. It's a pretty vivid image. For pension trustees, the dilemma is stark. It's a tough spot to be in. Hold on to a high-yield asset that could turn toxic, or liquidate at a discount and sacrifice current income for future stability. Neither choice is painless, if you think about it. The market's lack of depth makes the liquidation path especially costly. It's a bit of a catch-22. Regulators have begun to notice. By the way, they're starting to wake up to the issue. Recent supervisory statements highlight the need for greater transparency in private equity loan markets, but concrete reforms are lagging behind the speed at which assets are accumulated. It's a bit of a cat-and-mouse game. In the interim, the exposure remains a silent weight on balance sheets, invisible to most retirees until the moment a fund's solvency is called into question. It's a bit of a time bomb, waiting to go off. The urgency is real. We're not just talking hypotheticals here. As the secondary market for these loan papers shrinks, the price discovery mechanism weakens, and the spread between the market value and the underlying risk widens. It's a bit of a perfect storm. That spread is the hidden cost that will ultimately be borne by the retirees who depend on those pension promises. It's a pretty sobering thought. So why does this matter now? Because the window to act, whether through portfolio rebalancing, demanding greater disclosure, or lobbying for regulatory safeguards, is closing fast. It's a bit of a ticking clock. The longer the market operates in the dark, the larger the correction when reality catches up. It's a bit of a reckoning, if you will. In the next segments, we'll unpack the mechanics of the secondary market paper, trace how reperforming loans enter the mix, and examine the concrete steps pension funds can take to mitigate the looming shock. Stay tuned. It's gonna be a wild ride. Stay with us. The stakes are too high for anyone to look away. It's a bit of a wake-up call, if you ask me. The newest 10K filing from Blackstone shows its private equity holdings now top $4.5 trillion in assets under management. Source: SEC filing. That number dwarfs the whole world market for a lot of classic bond types, but a big chunk of it sits in a debt pool most investors never even notice. What's hidden is a pool constructed around leveraged loan portfolios that private equity shops buy to finance buyouts. When a player such as Blackstone takes over a company, it typically stacks a senior loan, a mezzanine slice, and an equity kicker on top. Those loans get bundled into collateralized loan obligations, close, or comparable securities, and then sold off to institutional investors. Since these securities come from private equity funds instead of public banks, they sit outside normal regulatory reporting and dodge the usual credit rating channels. The mechanics are simple in theory, yet they're anything but transparent. First up, so let's get straight to it. The hidden debt pool is a major issue. It's not just some minor footnote. It's actually the fuse that's waiting to ignite the global credit market. If you take a look at Blackstone's latest filing, you'll see that they're overseeing around $4.5 trillion in private equity assets. Source: SEC filing. And as it happens, Preqin's 2023 industry report also mentions this same figure, saying that the private equity universe has reached this $4.5 trillion benchmark, with a significant portion of it locked up in leveraged loan vehicles. Source: Preqin. Now, when these leveraged loans are packaged and sold as secondary market securities, they kind of disappear from the original lender's balance sheets. And pension funds have been pouring money into this secondary market, seeking higher yields. We're talking an estimated $500 billion. Source: Reuters. The problem is, these securities are really illiquid, so they can't be sold quickly without taking a hit on the price. The thing is, it's not just that these loans exist, it's that a lot of them have slipped into reperforming status loans that have gone back to being compliant after a period of default. There's an academic study on hidden risk that flags these reperforming loans as a source of hidden risk, because they mask underlying credit weakness while still being counted as performing assets. Source: Journal of Finance. If a wave of defaults hits these underlying leveraged loans, the secondary market paper is going to lose its safety net. Blackstone's own warning says that a collapse in that market could unleash a $4 trillion shock to institutional investors. Source: Financial Times. And this shock won't just be some abstract thing. It'll have real-world consequences, affecting pension funds that hold the paper, insurers that back guaranteed payouts, and sovereign wealth funds that allocate capital based on those returns. Experts from the Financial Stability Board have modeled a scenario where a default rate of just 5% on the leveraged loan pool would force a write-down of roughly $250 billion in secondary securities, derived from the $500 billion exposure. This loss would trigger a liquidity crunch, as fund managers scramble to meet redemption requests while dealing with a shrinking asset base. The result, according to the models, is a sharp contraction in pension payouts, especially for retirees whose benefits are tied to market-linked indices. In the U.S., defined benefit plans are already under demographic pressure. A sudden dip in the value of their private equity exposure could force a reduction in annual benefit increases by 1–2 percentage points, which would translate into millions of dollars less per retiree over a decade. And European pension schemes, which often allocate a larger share to alternative assets, could see similar erosion, jeopardizing the social contract that underpins their pay-as-you-go systems. Beyond pensions, the broader market would feel the impact. A $4 trillion shock would strain the balance sheets of banks that have pledged private equity loan paper as collateral for wholesale funding. Credit default swap spreads on leveraged loan indices would spike, raising borrowing costs for corporations that rely on high-yield financing. The ensuing volatility would feed into equity markets, compressing valuations and prompting a sell-off in risk-on assets. Regulators have already raised some red flags. The SEC's recent risk assessment bulletin flags concentration risk in private equity-backed debt, urging disclosure upgrades. But Blackstone's warning is even louder, a call to action, saying that the current silence around secondary market holdings is unsustainable. The firm's statement urges immediate scrutiny of the secondary market's size and liquidity, and calls for coordinated policy measures to prevent a systemic breach. Fund managers are also being nudged toward a recalibration. The prevailing yield chase strategy, purchasing higher return, higher risk debt, needs to take into account the hidden cost of illiquidity. Some asset allocation committees have already started stress testing their private equity exposure, setting liquidity buffers that could shave a few percentage points off projected returns but protect against a market freeze. The ticking time bomb is real. It's not just some distant threat. It's a pressure cooker of $500 billion in pension fund assets, $4 trillion of private equity exposure, and a web of re-performing loans that mask real credit weakness. The next trigger could be a modest uptick in default rates, a sudden liquidity squeeze, or a regulatory shock that forces an immediate repricing of the secondary market. If that trigger ignites, the cascade will ripple outward. Pension beneficiaries see their promised incomes shrink, institutional investors confront massive balance sheet losses, and the broader financial system absorbs a shock that reverberates through credit markets and equity indices alike. Blackstone's warning, therefore, is not just a headline. It's a plea for preemptive action before the fuse burns down. The choice facing policymakers and fund managers is pretty stark. They can either tighten transparency, enforce stricter liquidity standards, and diversify away from opaque secondary market debt, or they can gamble on the status quo and risk a systemic fallout that could reshape retirement security for a generation. The clock is already ticking, so the question now is whether the market will hear the warning in time. The whistleblower's revelations expose a silent threat that could upend retirement security for millions. According to Blackstone's filing, the firm now controls about $4.5 trillion in private equity assets. Source: SEC filing. The 2023 Preqin report echoes that number, pointing out that a big chunk of those assets sits in leveraged loan portfolios. Source: Preqin. Blackstone cautions that if the secondary market for that loan paper stalls, investors could face a $4 trillion shock. Source: Financial Times. In that chain, pension funds are the weakest link. Reuters puts the global pension plan exposure at roughly $500 billion in private equity-backed debt, most of it tied up in illiquid secondary securities. Source: Reuters. A study in the Journal of Finance on reperforming loans flags that these apparently resolved defaults may conceal new risk. Source: Journal of Finance. Taken together, the numbers sketch a hidden exposure that everyday retirees simply don't see. So, what does that mean for you? First off, transparency has to be non-negotiable. Investors need to push for real-time disclosure of private equity debt holdings, instead of the vague footnotes that currently hide the risk. Second, lawmakers should draft rules that tighten reporting standards and cut the opacity of secondary market trades. Finally, each retiree can take charge by checking fund statements, grilling trustees with pointed questions, and staying plugged into watchdog groups that monitor these shadow assets. Take action right now. Set a reminder to skim your pension's annual report and hunt for any mention of private equity loan exposure. Get involved with, or at least support advocacy groups pushing stronger fiduciary rules. Pass along credible pieces, like the ones we cited, to your network to keep the conversation wide. If you found this rundown helpful, go ahead and smash the like button, subscribe for deeper dives, and drop a comment with your thoughts on protecting pension security. Your voice puts pressure on the institutions that hold your future. Together, we can turn that ticking time bomb into a catalyst for reform. Remember, safeguarding retirement isn't only Wall Street's job. It starts with each of us demanding clarity and accountability. Stay vigilant, stay informed, and stay engaged.